Now time for Power Player, a look at some of the most notable names in private markets. The surge of cash into private markets raises many questions about valuations, but it also challenges the usefulness of public markets. Will they continue to become less relevant? I recently sat down with Tony Tutrone, head of alternative assets at Neuberger Berman, to discuss the issue.
There's no doubt in this kind of environment with high valuations, aggressive capital structures, it's going to be more difficult to get the kind of returns that private equity has gotten in the past. All that said, I still think it's going to do better than the public markets, who are also dealing with some of the same valuation issues.
How much better?
Well, I think in private equity, typically you look to do 300 basis points better than a similar index. Some are as high as 500, but I think that's still realistic going forward, even though absolute returns may come down. And then you also have to separate. There are some areas of private equity that are becoming more commoditized. But there are newer areas, more innovative areas of private equity that I think can produce even better results.
Like?
Well, look, I think one thing that's occurred in the last several years is the development of what is referred to as the GP-led secondary transactions. And one of the issues in private equity has been is even though it's long-term, the funds are finite. So GPs find themselves in a situation where sometimes they have to sell their very best companies before they're through making them better and achieving the highest returns. So what these transactions do, it gives the GP and their investors the option to roll into a new vehicle and to continue to invest in these companies and grow them so that you can achieve the kind of returns you want.
So when you talk about the returns, I want to talk about the exit strategy, because typically it's been the initial public offering.
Yeah.
You cash out. We've seen some difficulty there recently with the Peloton IPO that's been underperforming, with the WeWork IPO that was iced, with the Endeavor IPO that was iced. What message are you taking from that?
Yeah. So first I would say, Lisa, is that over the last decade or so, more than 50% of exits are sales to other companies, so selling to industries. The remaining 50 the share of IPOs has gone down. And look, when you look at some of these IPOs, I think the end of the day, it's about, is the story of the company, is the total addressable market there? And do the IPO investors think it's still going to grow? And I think that's really been more the problem even than the valuations, although I think there have been some unrealistic valuations that have been set in the market also.
Wait, so you're saying you don't think necessarily that these IPOs and sort of how much they've struggled indicates a broader overvaluation in private markets?
No, I think that there is, especially, I would say, on the venture capital late rounds. There's a lot of new entrants into that business that aren't typical VCs, and I think they have pushed up significantly the valuations, and I do think that's an issue. But I still think if you look at the IPOs that haven't occurred, I think it's more questions about the business model than the actual valuations. And maybe with the pricing of Peloton, for example, where it's probably pushed to the upper edge, and maybe the book wasn't as strong as the banks and the company thought it was, the transaction still got done, because I think there's still strong believers in that business model.
So going forward, are you expecting the IPO sort of pipeline to diminish dramatically, given what we've seen, and just the private sales of companies just kind of take over here?
Look, I think in the short term, I think the IPO market might be a little compromised because some of these failures and some of the IPOs that haven't traded well. So I think short term, yes. And I do think that there's a very strong M&A market that you can sell into. So large companies are looking for growth. And because they're large, one of the ways they achieve growth is by buying smaller, strong companies that get them into new growth areas that can make their businesses better.
When we were talking about returns, you're focusing on private equity mostly, and I'm wondering if you also think that private debt and real estate and some of the other alternative strategies will also continue to outperform.
Look, I do. And one of my big themes is that I think the private markets will continue to disrupt the traditional markets and continue to take market share away from the public liquid markets, as well as financial institutions like banks and insurance companies. And there are really good reasons why that is occurring, right? You cannot make transformational changes in a public company today. There's too much short-term pressure. right? A lot of times when a private equity company buys a company, the earnings will actually go down in the first few quarters because they're investing in the business for the future. And by the way, there's no access for capital for small companies.
There is an argument that the public market was a way for the mom and pop investor to access American dynamism, you know, to sort of get in on the early view of a particular growth story. How do they get in on the dynamism that is no longer going necessarily to the public markets?
The pension plans are allowed to invest in private equity, and they have professional investors that, and one of their biggest exposures and one of their best performing asset classes has been private equity. But in a 401k, you can't do it. In an IRA, you can't do it. And more, that's how we're expecting people to provide for their retirement. So basically, we need to bring private equity to the masses.
How much pushback do you get from investors about how much money has been flooding into some of these markets, private equity with a number of record of fundraising years? At a certain point, doesn't that concern you?
Even though there's a lot of money that's come in, the 1.1 or 1.2 trillion of dry powder is really nothing compared to the opportunity set in my mind. And again, it equals the market cap of Microsoft, one company. So we're just in the beginning innings in this market.